Okay, fixed coverage charge ratio. So fixed coverage charge ratio, or FCC, is earnings before interest and taxes plus lease payments divided by interest charges, lease payments, and sinking fund payments divided by 1 minus the tax rate. So if calculate that out, we end up with 2.2 times. Industry average 5.8 times. Again, this is much like our our times interest earned. We're our fixed charges are much higher than the industry average, or our earnings in relation to those are are lower. So again, Unilate is performing poorly. So it's not going to be as able to cover its charges as are other firms in the industry. So Unilate's debt position, debt ratio is higher than the industry. Coverage ratios are lower than the industry. Unilite's going to have a hard time borrowing additional funds until its poor debt position is improved. Um, it's also potentially, signs of impending default maybe at some point in the future. Profitability ratios, net profit margin, return on assets, um, return or ROA, it's more commonly referred to. Return on, most people don't use return on common equity. Just say they call it return on equity, or ROE. Uh, yeah, the one thing to note that all profitability ratios, they start out with net income. So profit margin is no different. Net income divided by sales. So our net income was 54 million. Sales were 1.5 billion. That's 0.036 or 3.6%. Industry average is 4.9%. Again, the profit margin is below the industry average. Their income per dollar of sales is lower than the average firm in the industry. ROA, or return on assets, again, net income divided by total assets, 54 million divided by our 845 million of total assets, 0.064 or 6.4%. The Our 10.3% for the industry average. Again, the Unilate is underperforming its peers. So that's, if I, okay, there we go. So return on equity, same story here. Return ROE, net income divided by common equity, 54 million divided by the 415 of common equity, that's 0.13 or 13%. Industry average 17.7%. Same we've seen from the all the other profitability ratios. Conclusion: the Unilate's profitability position, the operating results have suffered because of poor liquidity, poor asset management, and poor or too much debt. The final category of ratios, market value ratios. We have price earnings ratio. This is also PE ratio, referred to. Most people would call it PE ratio. And then market to book ratio. The PE ratio, or Unilate's PE ratio, this is an indication of how investors see the firm. A higher PE ratios tells you that an investor is more optimistic about the firm. So PE ratio is the price per share divided by earnings per share. So that's $23 per share divided by the earnings per share, or 10.6 times. You can also calculate the PE ratio by dividing market capitalization by net income. So just a note there. If you don't necessarily know how many shares are outstanding. So, but in this case, 10.6 times. Again, the industry average is 15 times. So the industry is a whole lot more enamored. The investors are a whole lot more happy with the majority of the other participants in the industry, as opposed to Unilate, given the lower PE ratio. In today's world, we have had for this is a trend that started in the 90s, and with regard to startup and tech firms, last time I looked at Amazon's PE ratio, it was like 70. Traditionally, PE ratios of less than 15 were common for firms. What that tells you, Amazon's PE ratio being so high, it means that the value of that share of stock is based on the future expectations for that firm. Market to book. So the market price per share divided by the book value per share. So in this case, the market value per share is $23. Book value per share is 16, so that's 1.4 times, again below the industry average. As you approach one, the closer you come to one, the more likely it is that a firm becomes a takeover target, for the simple fact that the firm could be liquidated for more than you would have to pay to buy the firm. So you'll probably, if you take other finance classes, you will probably see book to market. It's market to book is just the same ratio flipped around. And with regard to book to market, higher is better. Lower is better. With regard to market to book, higher is better. So it's telling you that both ratios are telling you the same thing. I'm not going to ask you to calculate book to market, but just so you know, if you happen to see that at some point in the future. All right. So Unilate's market value. Investors aren't too terribly thrilled about the prospects of the company in the future. So the next lecture, we're going to talk about DuPont analysis.